Peter Lynch. The name alone sends chills down Wall Street. This guy's a legend. But what makes him so special? Why does his name command such respect and admiration in the financial world? Well, let's dive into the story of Peter Lynch and uncover the secrets behind his incredible success. He ran Fidelity's Magellan Fund for 13 years, and let me tell you, he crushed it. During his tenure from 1977 to 1990, Lynch transformed the Magellan Fund into the best-performing mutual fund in the world. His ability to consistently outperform the market was nothing short of extraordinary. We're talking serious returns, folks, like averaging 29% a year. To put that into perspective, the average annual return of the S&P 500 during the same period was around 15%. Lynch's performance was nearly double that, a feat that very few investors have ever achieved. That's enough to turn a measly $1,000 into a whopping $28,000. Imagine the impact of such returns on a larger investment. People who trusted Lynch with their money saw their wealth grow exponentially, and they became loyal followers of his investment philosophy. Believe me, that's the kind of magic trick everyone wants to learn. But Lynch's success wasn't due to magic. It was the result of a well-thought-out strategy and a deep understanding of the market. He had a unique approach to investing that set him apart from his peers. Lynch didn't get there by playing it safe. He was known for his aggressive and bold investment style. He wasn't afraid to take risks, but they were calculated risks based on thorough research and analysis. He dove headfirst into the market, scooping up stocks like they were going out of style. Lynch believed in being fully invested and didn't keep large amounts of cash on the sidelines. He was always on the lookout for new opportunities and was quick to act when he found them. But here's the kicker. He didn't just buy anything with a ticker symbol. Lynch was meticulous in his stock selection process. He spent countless hours researching companies, analyzing their financial statements, and understanding their business models. Lynch had a knack for finding those hidden gems, the companies that were about to explode. He looked for businesses with strong growth potential, solid management teams, and competitive advantages in their industries. He was particularly fond of companies that were under the radar and not yet recognized by the broader market. He was like a bloodhound, sniffing out the next big thing before anyone else even knew it existed. His ability to identify these opportunities early on gave him a significant edge over other investors, and when he found it, boom, he bought it, big time. Lynch wasn't afraid to make substantial investments in companies he believed in. He had the conviction to back his research and take significant positions in his top picks. That's how you make serious money in the stock market, people. It's not just about picking the right stocks. It's about having the confidence to invest heavily in your best ideas. But Lynch wasn't just lucky. His success was the result of hard work, discipline, and a well-defined investment strategy. He had a set of principles that guided his decision-making process. He was smart, disciplined, and he had a system. Lynch's approach to investing was methodical and systematic. He didn't rely on gut feelings or hunches. He based his decisions on solid research and analysis. He didn't listen to the noise on Wall Street. Lynch was known for his ability to tune out the distractions and focus on what really mattered. He didn't get swayed by market trends or the latest investment fads. He didn't chase the latest fads. Instead, he concentrated on finding companies with strong fundamentals and long-term growth potential. He believed that the key to successful investing was to buy good companies at reasonable prices and hold them for the long term. He focused on what mattered, finding great companies with solid fundamentals. That's the Lynch way. His investment philosophy was simple yet powerful. Do your homework, invest in what you know, and stay patient. It's a timeless approach that has inspired countless investors to follow in his footsteps. Now, here's the thing about Lynch. He's not afraid to tell it like it is. Peter Lynch, the legendary investor, has always been known for his candid and straightforward approach. He doesn't sugarcoat the realities of the market, and that's what makes his insights so valuable. When Lynch speaks, people listen because they know he's speaking from decades of experience and a deep understanding of market dynamics. And right now, he's waving a big red flag about the market. This isn't just a casual warning, it's a serious alert that investors need to pay attention to. The market is sending signals that all is not well, and Lynch is making sure everyone is aware of the potential dangers ahead. Why? 2 words: high prices. When prices reach these levels, it often indicates that the market is overheated. High prices can be a sign that stocks are overvalued, and this overvaluation can lead to significant corrections. It's a classic case of too much optimism driving prices beyond their true value. Look, I get it. Everyone loves a bull market. The excitement, the gains, the feeling of financial security, it's intoxicating. Bull markets create a sense of euphoria where it seems like every investment is a winner. But this euphoria can be dangerous because it often blinds investors to the underlying risks. Stocks go up, portfolios grow, everyone's popping champagne. It's a time of celebration, and why not? Seeing your investments grow is a fantastic feeling, but it's important to remember that these gains are not guaranteed to last forever. The market is cyclical, and what goes up will eventually come down. But here's the truth. What goes up must come down. This isn't just a saying, it's a fundamental principle of the market. Every bull market is followed by a bear market. The higher the prices climb, the harder they can fall. It's a natural part of the market cycle, and it's something every investor needs to be prepared for. It's basic physics, people. Just like Newton's law of gravity, the market operates on principles that are predictable over the long term. When prices are sky high, it means one thing: the easy money has already been made. The opportunities for quick gains are gone and the risks are much higher. The market's gotten ahead of itself, and that's when things get dangerous. Overvaluation can lead to bubbles, and bubbles inevitably burst. When the market is driven by speculation rather than fundamentals, it becomes a ticking time bomb. Investors need to be cautious and not get swept up in the frenzy. Think of it like a balloon that's been blown up way too big. The more air you pump into it, the more likely it is to burst. The same goes for the market. The higher the prices go, the more fragile the market becomes. It's only a matter of time before it pops. It's only a matter of time before it pops. And when it does, the consequences can be severe. Market crashes can wipe out years of gains in a matter of days. Investors who aren't prepared can find themselves in a very difficult situation. That's why it's so important to heed warnings like Lynch's. Lynch knows this better than anyone. His track record speaks for itself. He's navigated through multiple market cycles and has seen firsthand the damage that can be done when the market corrects. His experience is invaluable, and his warnings should not be taken lightly. He's seen it all before. From the highs of bull markets to the lows of bear markets, Lynch has been through it all. His insights are based on real-world experience, not just theoretical knowledge. This gives him a unique perspective that few others have. He knows that when prices are this high, you need to be extra careful. High prices can create a false sense of security, leading investors to take on more risk than they should. It's during these times that due diligence and careful analysis are more important than ever. You can't just throw money at any old stock and expect to get rich quick. Those days are over. The market is more complex and competitive than ever. Success requires a disciplined approach, thorough research, and a clear understanding of the risks involved. So, take Lynch's advice to heart and tread carefully in these high-priced times. So, how do you navigate this high-priced market? It's a question that plagues many investors, especially in times of economic uncertainty and market volatility. The stock market can often feel like a roller coaster, with prices soaring one day and plummeting the next. It's easy to get caught up in the frenzy, but there's a better way to approach investing. You listen to the master, that's how. And what's Lynch's advice? Peter Lynch, one of the most successful investors of all time, has a wealth of knowledge to share. His track record speaks for itself, and his insights are invaluable for anyone looking to make smart investment decisions. Invest in companies, not tickers. This means looking beyond the stock symbol and understanding the business behind it. It's about digging into the company's financials, understanding its business model, and evaluating its competitive position in the market. It sounds simple, but trust me, it's profound. When you invest in a company, you're buying a piece of a business. You're becoming a part owner, and that means you should care about the company's long-term success. This mindset shift can make all the difference in your investment strategy. See, too many people treat the stock market like a casino. They think they can make a quick buck by betting on the next hot stock. But this approach is fraught with risk and uncertainty. The stock market is not a game of chance. It's a platform for investing in real businesses. They're chasing hot tips, gambling on short-term swings, trying to get rich quick. This speculative behavior can lead to significant losses, especially when the market turns against them. It's a high-stakes game that few can win consistently. But that's not investing, folks, that's speculating. True investing requires patience, discipline, and a long-term perspective. It's about finding quality companies and holding on to them through thick and thin. This approach may not be as exciting as chasing the latest trend, but it's far more likely to yield positive results over time, and it's a surefire way to lose your shirt. When you invest based on speculation, you're essentially gambling with your hard-earned money. The odds are not in your favor, and the potential for loss is high. Instead, focus on building a portfolio of solid, well-managed companies that have a proven track record of success. Lynch says, forget all that noise. Focus on the fundamentals. This means looking at a company's earnings, revenue growth, profit margins, and other key financial metrics. It's about understanding the business and its potential for future growth. Find companies that are killing it, strong earnings, solid growth, great management. These are the companies that are likely to thrive in the long run. They have a competitive edge, a loyal customer base, and a clear vision for the future. These are the companies that will stand the test of time, even when the market throws a tantrum. Market fluctuations are inevitable, but strong companies can weather the storm and come out even stronger on the other side. Think of it like this. Would you rather own a company that makes something people need and use every day, or a company that's all hype and no substance? The answer's obvious, right? Companies that provide essential products and services have a built-in demand, which can provide a stable revenue stream. Or a company that's all hype and no substance? The answer's obvious, right? Hype can only take a company so far. Without a solid foundation, it's only a matter of time before the cracks start to show. Investors who chase hype are often left holding the bag when the bubble bursts. So why are you investing in the hype? It's time to change your approach. Start focusing on the fundamentals and invest in companies with real value. This strategy may not be as glamorous, but it's a proven way to build wealth over the long term. Remember, investing is a marathon, not a sprint. Take the time to do your research, make informed decisions, and stay the course. Your future self will thank you. Here's another Lynchism that'll save your bacon. Look at the balance sheet. Yeah, I know. Balance sheets aren't exactly the sexiest part of investing. They're full of numbers and jargon, and they can make your eyes glaze over. But trust me on this one. The balance sheet is like a company's report card. It tells you everything you need to know about their financial health, how much debt they have, how much cash they're generating, whether they can weather a storm. Lynch loves companies with fortress-like balance sheets, low debt, tons of cash, and a solid track record of profitability. These companies are built to last. They can ride out recessions, they can invest in growth, and they can reward their shareholders. Remember, investing is like a marathon, not a sprint. You want companies that can go the distance, and that means companies with strong balance sheets.